Geopolitical conflicts are more than just political events. They create economic ripples that affect everyone, from governments to individuals. Let's explore how these conflicts influence global markets and reshape the economic landscape. When tensions escalate between nations, trade relationships often suffer. Sanctions, embargoes, and restricted access to markets can limit the flow of goods, driving up prices and reducing availability. Energy markets are especially vulnerable. Conflicts in oil-rich regions or disputes over pipelines can lead to price spikes, impacting transportation, manufacturing, and household expenses worldwide. Currency values also react to geopolitical events. Investors often move their money to perceived safe havens, causing fluctuations in exchange rates that can benefit some countries while hurting others. Stock markets tend to become volatile during conflicts as uncertainty drives fear among investors. Businesses tied to affected regions may see their stock prices drop, while others, such as defense contractors, might experience gains. Understanding these ripple effects helps us appreciate the interconnectedness of global economies. In the next part, we'll dive deeper into how geopolitical tensions impact energy markets and why it matters to all of us. Stay tuned as we uncover the complex relationship between politics and economics in today's world. Energy markets are among the most sensitive to geopolitical conflicts. From oil to natural gas, tensions between nations can disrupt supply chains and lead to price volatility. Let's explore how these tensions shape energy markets and their broader economic impact. Conflicts in oil-rich regions often lead to supply disruptions. For instance, disputes in the Middle East, a key producer of crude oil, can cause sudden spikes in global oil prices. These price increases ripple across industries, affecting transportation, manufacturing, and consumer goods. Natural gas markets are equally affected. Disruptions in pipelines or supply agreements, as seen in Europe during tensions with Russia, can lead to energy shortages and increased costs for households and businesses. Geopolitical tensions also influence renewable energy development. For example, disputes over access to rare earth minerals, crucial for solar panels and wind turbines, can slow down the transition to sustainable energy sources. In response to these challenges, countries often seek to diversify their energy sources. Investments in domestic energy production and alternative fuels aim to reduce reliance on geopolitically unstable regions. Energy security becomes a top priority during conflicts, with governments stockpiling resources or entering new trade agreements to ensure stable supplies. Understanding the relationship between energy markets and geopolitical tensions highlights the importance of resilience and innovation. In the next part, we'll explore how trade wars and sanctions impact global markets and the strategies countries use to navigate them. Stay tuned for more insights into the interconnected world of economics and politics. Trade wars and economic sanctions are powerful tools in geopolitics, but they come with significant economic consequences. Let's explore how these measures affect global markets, identify the winners and losers, and understand their broader implications. Trade wars typically arise when countries impose tariffs or restrictions on each other's goods. While these actions aim to protect domestic industries, they can lead to higher prices for consumers and disrupt global supply chains. Sanctions, on the other hand, target specific nations, industries, or individuals. These measures can freeze assets, block access to financial systems, or limit trade. For example, sanctions on oil-exporting nations often lead to global energy price hikes. The winners in these scenarios are often domestic producers who gain a competitive edge when foreign imports become more expensive. Similarly, alternative trade partners may benefit as they fill the void left by restricted nations. However, the losers include consumers who face higher prices and businesses that rely on international trade. Global economies also suffer as reduced trade slows down growth and increases uncertainty. Sanctions and trade wars can also have unintended consequences, such as strengthening alliances among targeted nations or encouraging innovation to bypass restrictions. For example, trade restrictions can drive investment in domestic manufacturing or alternative supply chains. Understanding the winners and losers of trade wars and sanctions helps us see the complexities of global economics. In the next part, we'll discuss how international organizations work to stabilize economies during geopolitical tensions. Stay tuned as we continue to uncover the interplay between geopolitics and global markets. In times of geopolitical conflict, global organizations play a crucial role in stabilizing economies and fostering collaboration. Let's explore how institutions like the International Monetary Fund, IMF, World Bank, and World Trade Organization, WTO, respond to economic challenges and support global markets. The IMF provides financial assistance and policy advice to countries facing economic crises. During conflicts, it offers emergency loans to stabilize currencies, rebuild reserves, and restore investor confidence. The World Bank focuses on long-term development, funding infrastructure projects and social programs to help nations recover from the economic fallout of conflict. These efforts support economic resilience and create opportunities for sustainable growth. The WTO works to resolve trade disputes and promote open markets. By mediating conflicts and establishing fair trade rules, it helps reduce tensions and maintain the flow of goods and services globally. Regional organizations also play a vital role. For example, the European Union and ASEAN promote economic integration and collective action during crises, enhancing regional stability. However, these organizations face challenges. Balancing the interests of diverse member nations can delay decision-making. Additionally, critics argue that some policies may disproportionately benefit wealthier nations. Despite these challenges, global organizations remain essential for mitigating the economic impacts of geopolitical tensions. Their efforts help rebuild economies, foster international cooperation, and reduce the risk of prolonged instability. In the next part, we'll examine how currency markets react to geopolitical crises and the strategies individuals and businesses can use to navigate these changes. Stay tuned as we continue to uncover the interconnected dynamics of global economics and politics. Geopolitical crises often send shockwaves through currency markets, creating volatility that impacts businesses, governments, and individuals. Let's explore how these crises affect exchange rates and strategies for navigating currency fluctuations. During times of conflict, investors tend to seek safe haven currencies, such as the US dollar, Swiss franc, or Japanese yen. This increased demand strengthens these currencies while weakening those associated with unstable regions. Currency depreciation can make imports more expensive for affected nations, driving up inflation. At the same time, it can boost exports by making them more competitive internationally. However, sharp currency fluctuations also create challenges for businesses, particularly those reliant on international trade. Companies may struggle with rising costs for imported goods or face uncertainty in pricing for overseas markets. Central banks often intervene during crises to stabilize their currencies. They might use foreign exchange reserves to buy their currency or adjust interest rates to attract investment and curb volatility. Individuals can protect themselves from currency fluctuations by diversifying their investments. For example, holding assets in multiple currencies or investing in commodities like gold can act as a hedge against currency risks. For businesses, tools like forward contracts and currency options provide ways to manage exchange rate risks. These financial instruments help lock in rates and reduce uncertainty in international transactions. Understanding currency volatility during geopolitical crises allows us to better navigate the financial impacts. In the next part, we'll discuss how stock markets respond to conflicts and the behavior of investors during uncertain times. Stay tuned as we continue to uncover the intricate links between geopolitics and global markets. Geopolitical conflicts bring uncertainty, and stock markets are often among the first to react. Let's explore how these crises influence investor behavior, market trends, and the global economy. During conflicts, stock markets tend to experience increased volatility. Prices may swing widely as investors react to news, predictions, and shifts in sentiment. Fear often drives sell-offs, while opportunities may attract risk-tolerant investors. Defense and energy stocks are typical gainers during geopolitical tensions. Companies in these sectors often see increased demand as nations prioritize security and energy needs. On the other hand, industries reliant on global supply chains or discretionary spending, like retail, may suffer. Safe haven assets, such as gold and bonds, attract investors seeking stability during crises. These moves can drive prices for these assets higher, even as broader markets decline. For long-term investors, geopolitical tensions highlight the importance of diversification. Spreading investments across sectors, geographies, and asset classes can help mitigate risks associated with market volatility. Active investors may use strategies like short selling or options trading to capitalize on market fluctuations. While these strategies carry higher risks, they can also provide opportunities during times of uncertainty. Central banks and governments often step in to stabilize markets, using tools like interest rate adjustments or stimulus packages. These interventions can reassure investors and reduce panic-driven sell-offs. Understanding how stock markets respond to geopolitical conflicts helps investors make informed decisions and navigate uncertainty. In the next part, we'll explore how supply chain disruptions caused by conflicts impact businesses and consumers globally. Stay tuned for more insights into the dynamic interplay of geopolitics and economics. Global supply chains are the lifelines of modern economies, but geopolitical conflicts can severely disrupt them. Let's explore how these disruptions impact businesses, consumers, and economies worldwide. When conflicts erupt, transportation routes may be blocked, production facilities shut down, or key resources become inaccessible. These disruptions create bottlenecks that delay deliveries and increase costs for businesses. Essential industries like technology, automotive, and pharmaceuticals are especially vulnerable. For example, a shortage of semiconductors, often caused by geopolitical tensions, can stall production of everything from smartphones to vehicles. Consumers feel the effects through higher prices and limited availability of goods. When supply chains struggle to keep up with demand, inflation rises, stretching household budgets. Businesses face tough choices. Some may absorb increased costs to retain customers, while others pass them on through higher prices. Smaller companies with limited resources are often hit hardest. To adapt, companies are rethinking supply chain strategies. Diversifying suppliers, investing in local production, and adopting technology for better tracking and efficiency are key measures to build resilience. Governments also play a role in mitigating the impact. Trade agreements, infrastructure investments, and strategic reserves can help stabilize supply chains during crises. Understanding the economic consequences of supply chain disruptions underscores the importance of preparedness and innovation. In the next part, we'll discuss strategies for adapting to an uncertain global economy. Stay tuned as we continue to explore the challenges and opportunities of a connected world. The global economy is constantly evolving, and uncertainty has become the new normal. Let's explore strategies for adapting to this ever-changing landscape, whether you're an individual, business, or policymaker. First, building financial resilience is key. For individuals, this means maintaining an emergency fund, diversifying investments, and keeping debt manageable. For businesses, it involves preserving cash flow and exploring alternative revenue streams. Flexibility is another crucial trait. Adapting quickly to changes, whether shifting supply chains, new regulations, or emerging markets, can give businesses a competitive edge. Embracing technology is essential for staying ahead. From data analytics to artificial intelligence, leveraging these tools can help identify trends, optimize operations, and make informed decisions in a volatile market. Collaboration is also vital. Building strong partnerships and participating in networks can provide support and opportunities during uncertain times. Governments, too, can collaborate on trade agreements and policies to stabilize the global economy. Investing in education and skills development is critical. As industries evolve, individuals and workforces must adapt to meet new demands. Lifelong learning ensures you stay relevant in a rapidly changing job market. Finally, staying informed is key to navigating uncertainty. Keeping up with economic trends, geopolitical developments, and market shifts helps you anticipate challenges and seize opportunities. Adapting to an uncertain global economy requires a proactive mindset and a willingness to embrace change. By preparing today, you can turn uncertainty into opportunity and thrive in the face of economic challenges. This concludes our series on the impact of geopolitical conflicts on global markets. Thank you for joining us, and stay tuned for more insights to help you navigate the complexities of the modern world.